Alright, welcome to another video. It's been a while since the last one, but here we go. Just wanted to run through a blog post here that we've got and also highlight another couple of charts that came from something that you might find pretty interesting. So the title of this article, as you can see there, is the Implied Correlation Index flashes a buy signal. Now, if you've been following the videos here, you probably would have seen, I think it was back in November, we actually covered this topic and I showed you the spreadsheet and sort of how we calculate this index. But basically what we've got here in the red line is the CBOE Implied Correlation Index. And you can kind of think of that as the cousin to the VIX or the VVIX or even the skew index. So these are all indexes that are derived from S&P 500 option prices, and this is basically telling you the option implied level of correlations between stocks of the S&P 500. And just on the methodology before we get into the interpretation, so you can see there that I've mentioned that there's the JCJ, the ICJ, and the KCJ. So we can't really call this one the SKEW in the case of the skew, or the VIX in the case of the volatility index. There's actually a few different indexes, and that actually makes it quite difficult from an analytical perspective. So what I've done is actually spliced them together, and basically the way that you do that is you have to chop and change as the old index starts to drop off and the new index starts to come in. They're obviously going to be trading at different levels due to the way that the index is constructed. You can't just have it join the new one onto the very end of the last one, because they tend to drop off in the later stages of into the expiry. But anyway, so basically it's a continuous series, and I've used 5-day moving average to smooth it, just because it can be quite a noisy series. But we can see there's a fairly clear movement in it, which we can use in the interpretation and application. And on that note, there has been a big move here, and very important to note too, by the way, is that that index is shown upside down or inverted. So a spike in correlations is going to be it dropping on the chart like it is now. And really it's quite interesting to note how that move there in this relatively sharp correction that we've had is quite similar in magnitude to what we saw actually in the depths of the financial crisis. So that's quite significant. Quite significant, the degree to which it has moved. It's also comparable to the corrections there in 2010, 2011, and yeah, it seems to be working as a kind of contrarian indicator, I guess you could say, or in that spikes and correlations tend to coincide with market bottoms. And why would that be? Because whenever you have a new indicator or an indicator that you're thinking about, you got to think about why it's working, not just okay, it seems to be working. So why it would be working like that is, of course, well, when you have a correction or a market panic, then everything tends to get sold at once, and if everything's getting sold at once, that means higher correlations between assets. So in the leading into the financial crisis, correlations across many asset classes tended towards almost one, right? And then you can see here that this post financial crisis period, the sort of risk on, risk off zone, you did see generally higher correlations around that period as well. And also the flip side is that when we see these lower correlations, that can be when trouble starts to emerge or a top starts to emerge. And again, the logic behind that, one thing that would drive lower correlations between stocks or sectors would of course be if a couple of stocks or sectors were particularly bubbly or frothy, and at risk of a have a correction. Or of course, if one sector or a series of stocks were coming under trouble, and I guess a good example at the moment would be the yield-sensitive stocks, so REITs, utilities, etc., that have come under pressure, and that probably helps explain how the correlations got that low. So long story short, and I guess the punchline of this article is that when you see these kind of moves, that's consistent with a sort of it helps in judging that there is a market bottom, and I think that that is probably at the point where you draw that conclusion. You could argue that there may be some more water to go under the bridge before the ultimate bottom is formed, but in the meantime, just looking at what it is at the moment, it looks like a tactical buying signal. The other thing I would mention too, and that would draw me into the other charts that I mentioned that I was going to show you, is how what this may actually even be is just a sort of the start of a return to a higher level of correlations. And so at this point we'll jump over to here, and this is the weekly chart storm. This is the premium weekly chart storm Twitter account. So if you want to get access to this, you have to go to that website there, Primo Social, this one here. It's an interesting website, actually. You should check it out. There's a lot of other good services on here as well. Basically it's premium Twitter feeds, and you pay a subscription fee, an annual, monthly subscription fee, and you get access to some pretty good material that you would not otherwise be able to get. And it's always good to pay for things, because then you can get a little bit more, I don't know, accountability, or a little bit more, assurance of quality, I guess, versus what's out there for free. Anyway, this here is the chart that I wanted to highlight. I'll see if we can blow it up a bit. Yes. So this is the average PY correlation across sectors of the S&P 500. You can see there that late 2017 it was getting down to the same levels that we saw around the height of the dot-com boom. And as I mentioned before, what was going on there was you had a few sectors really lagging, but then of course you had tech and telecoms just going bananas at that point. That was the really classical stock market mania that was driving that. And then of course, again, as I mentioned before, the risk on risk off period, where it was macro driving everything. And yeah, and I guess it sort of stands in contrast to the whole theme of or the idea that passive investing is going to change the way the index behaves, or that stocks behave. This would tell you that yeah, okay, that may be true for that period, but it's not really true at the moment, because if passive was ruling the market, then it would be you would see everything sort of moving in a similar direction, which would be up towards that one, whereas being down the slow. So the fact that it has turned around like this, I think that could be the start of a change in the regime, in terms of possibly higher correlations, and also possibly higher general volatility as well, which we talked about in this chart storm here. I've got a whole bunch of follower requests, but they get approved automatically by Primo Social. We have to pay for that. Anyway, that is about that, I guess. Unless you have any other questions or comments, put them in the YouTube video section below, and yeah, look forward to hearing from you, and we'll be keeping up with some more videos in the weeks to come.